Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Michael Taylor, investment manager at Baillie Gifford, and Sahil Mahtani, head of macro research at 91. We're here to discuss which sectors and companies stand to benefit from the $2.2 trillion that's expected to be spent over the coming decades upgrading the country's infrastructure. Michael and Sahil, it's great to have you with us. And Michael, let's kick it off here. I mean, that's a big number. $2.2 trillion. Give us some background in terms of what's expected for infrastructure spend in the US.
Oh, it's an absolutely vast number, and that's what really gets me excited. So here at Baillie Gifford, we're long-term growth investors, and many of your viewers might say, infrastructure, isn't this a bit boring? Is this the space for a growth investor? Well, for me, it's that 2.2 trillion number that gets me really excited. A lot of the growth in the last decade was software driven. That may continue to be the case. But I think physical things, infrastructure-related materials might drive the growth in the next 10 years. Why do I think that? Well, first of all, American infrastructure, and that's my specialism, I run our US Alpha strategy, is creaking. The American Society of Civil Engineers gives it a C- as a grading. And I think many of us, when we travel in the United States or do business there, will feel the impact of that lowly rating. So a quarter of bridges are functionally obsolete or need repair. Roads are crumbling. Water pipes leak an unimaginable amount of water every minute. So we're starting to feel the effects of infrastructure deficiency on a day-to-day basis, and that is what has fed into some of the eye-watering sums of money that are being invested in American infrastructure today. I personally think it's just the start. The $2 trillion that have already been signed into being are the size of 13 Marshall Plans. But that American Society of Civil Engineers, which I mentioned earlier, estimates that several trillion more on top of that might be necessary. So what gets me really excited, Jill, is that the demand picture at the moment for companies involved in the infrastructure space is staggering.
Yeah, well, it is something to be excited about. As someone who commutes from New Jersey to New York, are very well aware of the infrastructure issues that we're having in the Northeast corridor of the United States. And to your point, Michael, it is an economic issue in addition to, I mean, I'd even call it national security and a safety issue as well. It's just the infrastructure is just simply not functioning for what we need in today's society. So this is exciting, and hopefully we will get that investment, ultimately the execution on that investment. I think that's what's key as well. So Sahil, when you think about the key drivers of this particular super cycle, what are some that we should be aware of?
Yeah, I think there's a lot to agree there. I think we're on the verge of a capex super cycle. It's global, it's very large. Infrastructure is a component of it. The energy transition is a component of it. We've got European defense spending. We've got automation from demographic trends. We've got supply chains that are being rewired. And when you put all of this together, you look at global capex, it's a 25 trillion number. The estimates, when you put these all together, amount to something like an 8 to 13% increase annually between now and 2030. That's very large. It is 2 to 4 times global GDP. And I think it's important for a few reasons. It's important because it's a sea change from the last cycle, which was driven by deleveraging and by fiscal consolidation, and we had a resources overcapacity. So you kept inflation low, you kept growth, nominal GDP growth relatively low. So that changes. I think there are going to be many winners, which we can talk about. And I think it's also going to transform the macro environment to a higher nominal growth, higher inflation environment. That's very important for allocators to consider their portfolios about.
Yeah. Well, Michael, I want to address some of the shifts that we're seeing from an economic and political and policy perspective in the United States. There seems to be agreement that we do need to spend on infrastructure. But to my point earlier, we need to make sure that that money is going to the appropriate projects, it's being accountable for, it's being audited for. But the other concern is the supply chain and moving a lot of these processes and manufacturing back onshore. So there's seismic shifts that need to occur to execute on this $2.2 trillion investment.
Absolutely. I think that's a critical point, Jill. And one of the reasons I think I can get enthusiastic about infrastructure investment for here is that I think that we're entering a phase where it's regarded quite a bipartisan light. If we think of where that $2.2 trillion figure comes from, it's investments from the Inflation Reduction Act, the IIJA, the CHIPS Act. which in their sum are involved large parts of bipartisan support. So I think previously we've had a number of false starts, and in the 90s or 2000s where we might have things reversed as administration changes. I think the risk of that happening today is lower. Now you might ask, well, what gives me that confidence? Politicians say lots of things. Well, I think infrastructure insufficiency in the United States is starting to impact day-to-day lives. So that makes it a critical, very important issue for voters. But there's also the point you made earlier about national security. So yes, a lot of manufacturing, a lot of supply chains are moving back to the United States. And I asked myself, why is that happening? Well, the spur really was COVID. A lot of American companies discovered the vulnerability of having large parts of your supply chain overseas. And if we think that geopolitical tensions are likely perhaps to escalate in the coming 5 or 10 years, it becomes all that more important to have as much of your supply chain close to home as possible. So as this becomes a national security issue, not just a question of the roads in New Jersey, then I think that makes it all the more likely to persist through time. And it's that which I think really matters. It's not just the sums involved here, it's the consistency of the demand, which allows companies to plan around it, to have confidence to build capacity.
Yeah, well, I think part of the challenge is now, it's not clear yet if there's going to be an administration change. And while we understand the policies that the first Trump administration and first Biden administration had in terms of infrastructure and spend, it almost sounds as if there could be a policy shift, even though we have experienced both of their administrations. So to your point, I hope it's recognized as a bipartisan security issue versus, putting it into play as a political maneuver. But let's move beyond the politics for a moment here, Sahil. What sectors do you think stand to benefit the most from this spend?
Yeah, I think there's a big shift in the energy environment. Energy systems need investment. That's not just because of the decarbonization journey that some countries are on, but it's also just because we've got this data center boom at the moment. So even if you factor in some of the semi-chip improvements that are in the pipeline, electricity demand in the US is going to go from 0.2% per annum to 7.1%. So that's quite large. I think defense is a big component of this. The conversation that we're having in the US around state capacity and fixing things is a conversation that's mirrored in many other parts of the world. And in Europe in particular, it's very relevant for defense. Since the Ukraine conflict, we've seen defense spending estimates in Europe rise by 100 billion. Globally, they've risen by 200 billion in real terms since that conflict. And if you start, you imagine a Trump administration, you've seen Vance be very clear about what he wants from US allies. If you started to see defense spending increase to that 2% threshold for NATO allies, and the countries at 2% go to 2.5%, that figure then goes to 700 billion. And you've seen some of the European defense names perform very well in that context where demand is, the demand signal has been unleashed by governments effectively.
Yeah. And Michael, you made a great point. I'm sorry, go ahead.
I was going to build on something that Sahil said there. One of the things which really interests me at the moment is it's not just a case of when we talk about infrastructure, it's just roads or just railways or water pipes, what we would traditionally think of as infrastructure. Infrastructure are the vast and vital networks that we build our economies on, and they change. What is required changes over time. So not only today are the existing pieces of infrastructure we have not up to scratch, we need whole new things. So Sahil mentioned data centers. Well, if you consider infrastructure as being anything that moves something from A to B that's necessary, be that water or be that people, at the moment we need information and we need computing power. That's going to drive the economy over the next 10 years. And the infrastructure that will power that shift doesn't exist in nearly the size that it needs to today.
Right. It's like you can use the analogy, you can make all the EV cars you want. If you don't have the infrastructure to power them and service them and make them economical and available at scale, doesn't matter if you don't have these
Absolutely.
structures in place. But you make another great point, and this is why I was talking about accountability and auditability at the start here is, history shows that a lot of these massive infrastructure projects end up bankrupt or severely overcost. So what do you look at when it comes, in terms of making a good investment and not running into that risk of this ballooning of expenses and, ultimately projects that just never come to fruition?
Absolutely. I mean, infrastructure has been a tremendous way to lose money over long periods of history. So I'm a historian by training at Baillie Gifford. We try to take the very long view of things. And if you look at the 19th century, British railway booms lent themselves to bubbles and then collapses. If you ever want to read something horrifying, read about the history of the Panama Canal, the amount of money that was lost there and lives too. And that happens because these things cost so much money and they're often funded with debt. So you're getting a relatively marginal return, you're taking a fair amount of risk, and then there is the tendency for costs to balloon, and the suppliers to the project are very, very critical. So much of what I've talked about, and Sahil's talked about so far, relates to demand. And that is a critical part of any investment case, but just as important is supply. So what we at Baillie Gifford on the My US Alpha strategy try to do is look for bottlenecks in that supply. So demand might go up. If that is just met by commensurate levels of competition, then no one's going to make any money. But there are certain parts of the supply chain where you're getting that supply bottleneck. If I might quickly mention one, a company that I'm really interested in at the moment is Stella Jones. This is a wood products company. Perhaps their most important product line is telegraph poles to support the electrical grid. Now that area needs a lot of investment. It's not designed for dispersed sources of power generation. It's not designed for electric vehicles and so on. So we're going to have to build out that network. And would you believe telegraph poles are in short supply? So only 5% of trees can be used. They need to be at a certain height and lack branches. And there are two companies in the United States or North America, one of them is Canadian, that control the supply of those poles. So I'm looking at that and I'm seeing demand is going to go through the roof. I think supply will be restricted. That means pricing. That means returns on capitals and probably a re-rating of the shares. I'm an equity investor. So what we're trying to do is take that demand picture, but be selective and find those that are also experiencing a beneficial supply picture.
Yeah, and Sahil, I'm looking at a couple of the companies that you call out as well. When you're trying to think outside of the AI trade, your company's automation tech, construction, arms manufacturer, electrical, climate solutions. I mean, this is thinking beyond that black box of, the 5-6 stocks that have the AI trade. But again, you can have all the technology you want if you don't have the infrastructure and the power and, the energy to supply this. It's just not going to go anywhere. So I think, the investment thesis that you lay out here is interesting as well.
Yeah, and sorry, I'll just add to what Michael was saying earlier about the infrastructure build out that supports some of these some of the AI stories that we've seen. You look at the organic guidance on the revenue side for some of these companies, and you look at it pre-COVID and you look at it after COVID, and they're up 3 to 4 to 5 to 6 percentage points. I mean, I look at a company like BAE here in the UK, defense company, big supplier for the war. It's gone from a 0% revenue guidance to something closer to 7%. And so the demand signal is important. It's important to be selective. You have to make sure that the companies can actually generate returns on invested capital. But one pushback I've got to this thesis is how are companies going to invest so much money over the coming decade given higher rates? And actually, I think there are two responses I give to this. The first is that rates are in restrictive territory, but they're expected to fall considerably between now and next year. But I think more importantly, CFOs have been very conservative, right? I mean, you look at these CFO surveys from the 80s and their investment hurdle rates are in the 13 to 14 percentage points. And their estimated weighted average cost of capital is 6%. So they've always maintained a very strong hurdle rate, regardless of what rates have done. And I think as soon as companies start to see the demand signals come through, they are able to make some of these investments with a bit more confidence. So, just as we had very little investment uptick while rates were close to the floor in the 2010s, I think investment could rise even with rates considerably higher than they were pre-COVID.
Yeah, I think it's a great point that you make it. Even if we take it from a more microscopic point of view, I mean, going into the beginning of this year, we were expecting 6 to 7 rate cuts in the US. It never happened. Market went to all-time highs. We're pretty close to there now. And it was largely focused on fundamentals for all intents and purposes. For the most part, well-capitalized, clean balance sheet companies have weathered higher interest rates. And to both your points with, interest rate expectations with rates being cut, it only, not to have too rosy of a crystal ball, but it only seems to improve the scenario if they've been able to prove they operated quite well in a challenging environment. And there is no roadmap, by the way, coming out of a pandemic. And I think for the most part, companies that are run well, solid management teams did a good job executing.
Yeah, I would just add very quickly that this is a very global story. A lot of companies in emerging markets in particular were thought to be doing very poorly in a period where the Fed raised rates from 0 to 5%. And actually, by and large, you haven't seen that emerging market crisis because the companies have been very conservative with their balance sheets, and the countries they were in have maintained very conservative debt levels. And actually, that's quite a contrast to what we're seeing in Europe and the United States, where public debt levels have risen considerably since COVID.
Yeah, well, I would also argue that there's that demand for packaged products in terms of, alternative ways of deriving income and yield. I think that's part of the scenario as well. But all great points, Sahil. Michael, anything else you'd like to add as we wrap?
Well, the final point I would make there is on the resilience of these businesses. They have been stress tested, many of them, in the most profound fashion. So it's not just interest rates, it's not just COVID, it's been tremendous inflation. And I think it really pays to be selective to see how they've been through fire in the last 3 years, and our knowledge of how these teams and these business models work has increased substantially. Like just on that inflation one of my favorite companies at the moment is a business called Martin Marietta. They make gravel, they produce it, they dig it out of the ground, and the pricing in gravel is absolutely extraordinary. So it goes up year after year after year because it's such a small part of a critical product. You don't, it's often used in highways. You don't not build your highway because the price of gravel increased. So for me, I feel like the last 3 years have given me a lot of incremental, meaningful knowledge in the companies that I invest in this space that might be lesser well known, but have shown themselves to be something remarkable.
All right, we appreciate the exposure and insight. Thanks so much for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill. Great to be here.
Thanks, Jill.